Hey everyone, welcome back to the Financial News Podcast. In this episode, we're going to dig a little deeper into the latest on the Fed and interest rates. We did a high level on this yesterday morning, and here we're going to go deeper on that topic specifically. So for part one of this, the Fed just cut their rates of the benchmark interest rates for the second time this year at their meeting on October 28th and 29th. The Federal Open Markets Committee lowered their target range to 3.75 to 4%. And in a statement, the committee said uncertainty about the economic outlook, quote, remains elevated, and that the downside risks to employment have increased, which I totally agree with. The reason this matters is that a rate cut signals that the Fed believes the risk of the job market weakness is rising. So for real estate and borrowing costs, that means, lenders might price in lower rates, but from the Fed's perspective, the path to that policy doesn't sound super clear based on how they're kind of given context. So lower rates equals cheaper borrowing, but if the economy slows, that could push demand down. Part one of this is basically, the Fed is easing, but they're vocally staying cautious. For part two of this is kind of the fascinating part. There's a growing split among Fed policymakers about future cuts. So, for example, Lisa Cook, who's a Fed governor, stated at the Brookings Institution that a December rate cut is, quote, is not a foregone conclusion. Meanwhile, Mary Daly, who's the president of the San Francisco Fed, said that she supported the recent cut and remains open-minded about another in December, but emphasized incoming data is key. On the hawkish side, Austin Goolsbee of the Chicago Fed said that he's on the fence about cutting again, citing inflation that remains too high, which is kind of interesting. You've got some dovish and some hawkish comments there, but they're all kind of mixed and highlighting a little bit of caution. So yeah, just interesting to see. So policy is data-driven. It's not on autopilot, and markets hate uncertainty. And if some Fed members lean hawkish, which is no cut, while others lean dovish, which is cut, creates volatility in rate expectations, which feeds into mortgage rates, long-term borrowing, and asset valuations. So don't assume rate cuts equal done. The Fed is carefully looking at both inflation and employment is how I'm reading that. So we'll see. I think a December rate cut, I hope we get it personally, but it'll be interesting to see how this unfolds. So part three of this is all around the government shutdown and the data gaps that we're experiencing because of that. So the ongoing U.S. federal government shutdown is complicating the Fed's job because key economic data is either delayed or literally missing. For example, the Congressional Budget Office estimated the shutdown could cost the economy somewhere between $7 and $14 billion in permanent losses if the shutdown persists. Also, the shutdown has halted many statistical releases from agencies like the Bureau of Labor Statistics and the Bureau of Economic Analysis, and that leaves the Fed kind of flying blind, or at least partially blind. This is important for interest rates because when the data is weak or completely missing in this case, the Fed is more cautious. Less clarity on jobs, inflation, and spending makes policy riskier to set and could lead to either, more aggressive easing if conditions worsen or more of a hold tight stance if inflation concerns dominate. Also, for the real estate market, less transparency equals more uncertainty around what rates will do. So the bottom line is the shutdown is a wild card in the rate outlook going forward here, at least in the near term. Part four, around mortgage rate trends and market expectations. So those are adjusting based on the Fed and economic backdrop. So according to recent data, experts expect a 30-year fixed rate mortgage to remain in the low to mid 6% range through November, which I think that's probably accurate unless there's something we completely don't foresee right now. But I think, I agree with 6% through November. The daily mortgage rate index from the Mortgage News Daily shows that the 30-year fixed is around 6.34% and ticking slightly upward. Me personally, I really like to check bankrate.com to get some up-to-date rates because they do have some companies that are advertising what's current on their website sometimes. So, even though the Fed cuts rates, mortgage rates aren't collapsing because long-term yields and the risk premiums are still elevated. And that means buyers still have relatively high borrowing costs to contend with, which is kind of interesting to see. If you'd asked me a year ago, I thought we would have been lower by now, but it does seem that at least for the immediate future, 6% is a pretty good reality. So the key takeaway there is rate relief is modest and timing is crucial if you're in the market. And finally, kind of the last section here, the labor market backdrop and inflation risks continue to pull the Fed in both directions. For example, recent commentary published by Reuters on October 29th entitled U.S. job market is now shifting to, basically less hiring and more firing mode, meaning fewer new hires and more layoffs, offering, more ammunition for the Fed to consider rate cuts. So at the same time, inflation remains elevated. Some Fed officials have explicitly warned that cutting too soon could unanchor inflation expectations. And the Fed's dual mandate requires balancing price stability, aka inflation, and maximum employment. So if the job market weakens, that argues for cuts. But if inflation stays high, that argues for holding rates or even raising, which I would not be a fan of, but it's possible. So this seesaw is creating the tension we see in the divergent Fed commentary today. So, what I think this means for the everyday person is whether you're investing in real estate or managing debt or following markets, strong inflation plus a soft job backdrop is a tricky combination, and interest rate moves will reflect that uncertainty. So to wrap up, we saw the Fed cut rates, but signaled that further moves aren't guaranteed. We've seen Fed officials pretty divided. The government shutdown still muddying the waters by suppressing key data releases. Mortgage and long-term borrowing rates remain elevated despite this cut that just happened. And then finally, the labor market is showing cracks, but inflation risks persist, which is exactly the dilemma that the Fed is facing. So what this means for you, especially if you're in real estate and finance, stay flexible. If you're buying or refinancing, know that rates move, but don't expect a dramatic drop. If you're investing, keep an eye on both employment and inflation data. And if you hit the like button, subscribe, and drop a comment below with what topic you want me to cover next. Thanks for watching, and I'll see you next time.